What's up, everybody? Happy Tuesday. How did the market do today? How did you do today? Urgently up 52%. Really small cap company. Let's see if some of the bigger companies moved a lot. These are the top gainers. The top gainers. Leggett and Platt up 32%. That's a $1.3 billion company. Leggett and Platt. I think I know what kind of company that is, but I don't want to. Okay, so they manufacture mobile homes, is that right? Oh, they manufacture components and products that can be found in homes and autos. 1883, that's a pretty big jump for one day, especially a company 130 years old, 140 years old. Why'd it go up so much? 32% in one day. Did they have really good earnings? Leggett and Platt. 1Q sales of $1 billion, a 7% decrease versus 2024. So why does the stock go up when it doesn't look like they had good results? Well, depends how the stock has been doing the past few weeks. If investors expected really poor results and the results weren't as bad as they thought, the stock can go up. 1Q sales of $1 billion, 7% decrease from last year. Operating cash flow $7 million, a $13 million increase. So that's a big deal because last year they had a $6 million loss, cash flow loss. Guidance is another big factor. If guidance is really good, if future guidance is really strong, the stock can go up. Sales of $4 to $4.3 billion. So it just looks like the stock was gotten a little beat up prior to earnings. And we can see that if we look at the stock price, maybe the past few months, it was 18 a year ago. So it's down 50% from a year ago. So it's really gotten beat up. Well, look at the stock. In 2021, right after the COVID rush, it almost hit 60. That's probably its all-time high. Yeah, that's its all-time high. So it almost hit 60 in 2021. And now it's down to 10. 60 to 10. If you're into the stock, you'll probably, when's the bottom? When am I going to see the bottom? I think we saw it. I think the bottom came psychologically when it's kind of like when you like a gas station, they sell gas for $3.99. Psychologically, that sounds better than $4, even though it's only a penny apart. Same thing with stocks. That psychological barrier when the stock dips below $10, it's like it seems like it's such a great deal. Like $9 versus $11. They're still one away from 10, but it's just that psychological factor. But I'm not too familiar with that company. Let's move on. Hims and Hers, 23% in one day. This is one of those really popular stocks. I might say a meme stock, but Hims gets a lot of activity. Why did it go up 23%? Like it got real high. It got over 70, and this was a SPAC, I believe. Special Purpose Acquisition Company. Hims a SPAC? That's one of the main reasons I would stay away from Hims. Is Hims a SPAC? It's a telehealth company. That's true. Yeah, it is a SPAC. Okay. So it's like it kills me that I sold my Palantir stock. It really kills me. I guess you could always go back in your head and think about, oh, I should have did this, I should have did that. But whatever. I just got to get over it. It's really hard to let those things go. But what happened on Hims? Why did it go up so much today? 32%. No, that's 23% in one day. Wegovy to be sold on Hims. So the weight loss drug Wegovy. That's big news. How did they get Wegovy? Because Wegovy is sold by who makes Wegovy? Is like it corners the market on weight loss drugs. They have the Ozempic and Wegovy. So that's why you don't see these other companies selling weight loss drugs, because it's patented. When a patent expires, then other companies can sell the generic version, but they're going to be. So Hims got down to it looks like the mid-20s. Did it fall below the mid-20s? Wow, 52-week range is 11. So I don't even see 11 on this chart. I don't know how it got down to 11. Let's look at this website. Maybe it's easier to see the chart on this site. So you get, I mean, Hims got real low. I mean, it IPO'd at 10, so obviously it was single digits at some point. And for a while it was trade $3.11. That's a low. But in the past 52 weeks, it says it hit 11. Okay, I guess I see in at the end of 2024 it got to that level. Okay, this could be a good time to get your Hims stock. I actually bought Hims. I used to get the spray because I was losing my hair, so every day I had a spray. I don't know if it worked. It definitely dried my skin. Now I just take a pill, so I don't really use them anymore. Okay, Hims stock price. So why did it go up so much? It was just strictly off of Wegovy. Hims to sell Novo Nordisk Wegovy in U.S. Oh, right here, and U.S. share soar. Hims and Hers to sell Novo Nordisk's Wegovy in U.S. Shares soar. The deal ratchets up competition in the weight loss drug market. Well, this is Wall Street Journal, so we can't really get the whole picture. It's so annoying. Okay. Oh, Investopedia has an article. Investopedia usually has more kind of like informational articles, not like today's news, but it has today, April 29th. Hims and Hers stock surges on Wegovy deal with Novo Nordisk. Hims and Hers share surge Tuesday. Announced a partnership with Danish drug maker Novo Nordisk. So Hims and Hers will have access to Novo Nordisk's Wegovy starting this week. So Wegovy is a patented drug by Novo Nordisk, and Novo Nordisk is the only person that could sell this drug. But it looks like they have an agreement with Hims and Hers, so they're going to sell it to Hims, and then Hims will sell it to their customers. And obviously, Hims gets a little cut of the action, and so does Novo Nordisk. It's just it's hard to reach out, getting distribution, reaching out to people. It's not easy. That's why you kind of have to team up with companies. Telehealth companies are the best companies in the medical field because they have access to so many customers. All their subscribers, if you receive emails from Hims, or if you're on their list for anything, you will get notified that they're going to be selling. I wonder what they're going to say, what the name of the drug they're going to call it. They may take the drug and put it into their own product and then brand it their own name. So that'll be interesting. The telehealth company had benefited from selling compounded versions of popular weight loss drugs when they were in supply shortage. But the FDA said in February that Novo Nordisk's Ozempic and Wegovy are no longer in a shortage. Okay, so they got out of a shortage. I guess demand was really high, and they just didn't have enough product to sell. That's pretty surprising. They'd be in a shortage, but I guess that's possible if that's what they're saying. Shares of online health Hims soared 27% Tuesday after the company announced a partnership with Novo Nordisk to bring weight loss drug Wegovy to its customers. The company said in a statement Tuesday that users will be able to buy bundled offerings of all doses of Wegovy and Hims and Hers membership starting this week. So for $600, if you're a member of Hims and Hers, you can get Wegovy. So it's for $600. Let's look at Hims' website. I'm always curious, like how they actually sell it. Okay, so it's obviously a weight loss drug. That's what Wegovy is. Well, it's a diabetes drug, and people who were taking it for diabetes noticed they were losing weight, and they kind of like pivoted and said, "This is actually a weight loss drug." Get started. So we're gonna have to go through a questionnaire. So I don't think I'm gonna go through this. I just really want to get an idea of like the plan, like how much you pay. This says $600, so I don't know if that's like a one-time fee or it's well, $600 spread over a year. Let me know in the comments if you know. Hims and Hers had benefited from selling compounded versions of popular weight loss drugs when they were in supply shortage. But the FDA announced in February that Novo Nordisk, Ozempic, and Wegovy are no longer in a shortage. The FDA said it would give drug compounders until mid-May, taking enforcement actions to prevent them from selling compounded versions of the medications. Yeah, Eli Lilly is part of the. This move comes after Hims and Hers said it would add Eli Lilly weight loss drugs. Hims and Hers said it would add branded. That's a hard word to say. Tirzepatide, the active ingredient in Mounjaro and Zepbound, to its platform. Eli Lilly said on the same day it had no affiliation with Hims and Hers, and that Zepbound can be prescribed by any licensed healthcare professional. With Tuesday's gains, Hims and Hers shares have nearly tripled in value over the past 12 months. So if you own Hims and Hers, I'm not sure. Well, it's definitely trading. It's about half its all-time high. But as you can see in our article, in the past year, triple the stock price. So I don't know how much more upside potential there is, but this is pretty exciting news for Hims. Let's see what else. What else went up today? Metsera went up 18%. That's 2.4 billion market cap. Claravit. Why does my computer work? Claravit went up 17%. Claravit. What is Claravit? Claravit is a British publicly traded analytics company that operates a collection of subscription-based bibliometrics and cytometrics. What the hell? Claravit. I never heard of this company. Is anybody familiar with Claravit? CLVT. Yeah, right here, CLVT up 17%. It was formed in 2016 from the acquisition of Reuters and 1X Corporation. Huh. In May 2019, Claravit merged with. Okay, this is a SPAC. Is anybody familiar with this? Let me know in the comments. I'm not too familiar with this company. But this is really interesting. It's up 17% today, 2.9 billion market cap. What is ticker? CLVT. This is why we gotta, for you swing traders out there, this is the kind of things you have to kind of keep an eye on. So Clarovit was $7 at the peak, and that was in mid 2024. And then it came way down, cut in half, more than cut in half, $3.10, and had a really big surge today, almost up 18%. But why did it go up today? Does anybody know? Clarovit Q1 loss widens, reaffirms full year guidance, stock up in pre-market. Huh. So their loss is bigger than expected, yet the stock went up. Founded in the 90s. So this is like an exchange. Has anybody ever swung trade Clarovit? This is this could be a really good opportunity for you short-term traders out there. I myself, I'm a buy and hold kind of guy, but this is the number one thing if you want to trade on a short-term basis volatility. You can literally put $100 that a stock will go up, and you can put another $100 stock will go down. If the stock is flat, you get no money, right? But the stock goes to the moon, you make a lot of money. So you need volatility. So that's why you play both sides of the equation. Clarovit stock movement is primarily influenced by impressive first quarter revenue of $594 million, which exceeded expectations due to higher renewals and new business wins. I hate these websites. They give these generic, it's like a sentence and they just plug in like the number. I want a real like analyst report on the, here we go. Australia, when you need help, go to an Australian website. Okay, so Clarovit reported first quarter results that beat expectations, driven by accelerated recurring organic revenue. Shares were up 10% in pre-market trading following the release. This is a tough one. I don't know many people who would buy the stock. This is not one of the common stocks to trade. But today, it did really well, up 17%. LZ Technology Holdings, 1.4 billion market cap, up 14%. Shift4 Payments. Shift4 Payments up 13%. Shift4 Payments. Shift4 Payments. On the Pennsylvania company, come on. Can't even look at the website. Okay, let's go to a different site. Shift4 shares surge 11% on earnings beat as fintech stocks climb on results and upgrades. Shift4 stock 11% raised full year guidance and topped expectations of payment volume. So this is like a fintech. I actually am invested in a Brazilian fintech called Nubank. Upstart gain on Bank of America upgrade, citing improved fundamental, stronger. And PayPal is in this space too. PayPal owns Venmo. That's why PayPal has been doing so well. PayPal shares rose modestly as analysts highlighted surprising strength in brand volume and Venmo revenue despite a cautious outlook. So how did New do? Nubank, I'm actually up like 200% on my Nubank investments. 11% this week, pretty good. Okay, I'm happy about that. Shift4 Payments is a fintech. It sounds like it's a payment processor. Yeah, it's a payment processing company. There's so many payment processors out there because it's a profitable business. The company founded in 1999 by then 16-year-old Jarrett Isaacman, processes payments for over 200,000 businesses in the retail, hospitality, leisure, and restaurant industries. Wow, a 16-year-old kid founded the company. It's pretty impressive. Tenet Healthcare, pretty big company, 13 billion market cap, up 12% for the day. Smithfield Foods, up 9%. Crown Holdings, Viking Therapeutics, Noble, Crane Company. SGW. Let's look at the losers. See the big losers for the day. 99 point. This excites me. How does stock go down 99.69%? Arrowvit Therapeutics. They obviously, it's probably a company that was the patent was they didn't pass the state because when you have to when you want to sell a drug, right, you have to go through like 4 phases with the FDA. So you have to like maybe get 30 people and test the drug on 30 people, and then you have to log the results, and then you have to present that to the FDA. And if they approve phase 1, then you have to go to phase 2, and then you have to maybe change the dosage or maybe give a higher dose. But you have to test on a lot of different people, older, younger, black, white, and then because it's if you manufacture a drug and it kills people, that's really bad. So that's why it's very expensive and long process in order to get a drug approved. It could sometimes up to $1 billion. So I have a feeling they didn't pass one of the phases. Because how does stock go down 99.7% in one day? It's just fun looking at that. But didn't that look weird? 99.7%. It's a big company too. 2.7 billion. Like when you see a big drop like this, it's usually like one of these smaller companies, like this one right here, 2.86 million. Jade signs completes closing a merger with it. Oh, Arrowvit. Remember we were talking about that earlier? Arrowvit Therapeutics. Look at that. It all comes full circle. Okay. So a biotechnology company focused on developing best-in-class therapies for autoimmune diseases today announced the completion of its previously announced merger with Arrowvit Therapeutics. Combined, the company will operate as Jade Biosciences, with the shares expected to be traded on NASDAQ in April today, April 29th. Immediately prior to the merger, Jade successfully completed a previously announced Okay. So in order to combine two companies, one of the companies had to do a 35-for-1 reverse stock split in order to get the shares to align. So the two companies can come together. Good evening. What is a ticker symbol for NU? NU. I'm up about 200% on that. I just got real lucky. I bought it like I think it was 4.25. Nubank. On a percentage basis, yeah, I paid $4.24 in June 2022. I was nearly up 300% at one point. But this is interesting. 1 for 35 reverse stock split. Aerovit will distribute previously announced special cash dividend of $2.40 per share. NeoGenomics down 34%. So I would ignore the negative 99.69%. This is just from a merger. The stock didn't go down that much. It's just that, like, the stock price may have been 100, and now it's down to 1, just so it fits with the other company, if that makes any sense. Let's see, Brinker and Sparity. Hertz. Hertz has been real volatile lately. Have you noticed Hertz has been really moving around a lot? Look at that surge. On April 15th, it was $3.65, then shot up to over $8. And then it's been trading sideways. And then today it went from $8.51 down to $7.35. So there was a pullback. If you trade volatility, you could make a ton of money on Hertz. Okay, Bill Ackman bought Hertz. So when you see a big investor, he owns a hedge fund, then other people kind of pile into the stock, and that's why it goes up or down. Billionaire Bill Ackman is one of the most closely followed investors. Pershing Square is known for betting on. So I was surprised to see Hertz stock skyrocket after Ackman's fund disclosed a stake in a car rental business. Hertz shares jumped 126% in 2 days as of trading on Thursday. So he bought 20% of the company. Well, you bought Hertz at $7 or new? Oh, you're probably talking about Hertz, right? Nice. Well, now it's a little over 7. You just missed a run up. Ultra Clean Home. Oh, it hurts. Okay. ACM Research, Merchants Bank, LGI Homes, Hillman Solutions, NXP Semiconductors went down 7%. The Dutch semiconductor company went down 7%. I mean, it's a big company, NXP. 46 billion market cap. Why did NXP its inventory levels materially increased, and next quarter's EPS guidance was just in line, seemingly not enough to excite the market. Okay, when inventory levels rise, that could be a red flag, because you don't want to be sitting on so much inventory, because inventory can go stale. So there's some concern about that. Some companies have gone out of business because of inventory, poor inventory management. I know personally some people who did that. Regeneron Pharmaceuticals, 62 billion market cap, went down 7%. Webull. We keep seeing Webull, right? It seems like every day we're seeing Brown & Brown, UFP, Rambus, Immunity Bio. Okay, that's interesting, right? So I downloaded every stock with a ticker, a dividend above 10%. And you see these really high dividends, right? Like 175%. It's crazy, right? That doesn't make sense. But some of these really make sense. Like a 30% dividend. Sometimes a stock will pay that dividend. So let's leave a comment, throw out a ticker, but maybe we should look at some of these tickers and run it through my dividend model. Pretty simple model. And let's see if it's a real dividend. Maybe we can take advantage of this and make some money. You know, when you see like a REIT paying a 75% dividend, that probably does. It could be a timing thing, and sometimes these websites have bad data. But it just, when it's that high, that could be, that's usually bad data, or just something's off. FHI just increased its dividend by 10%. FHI. Really? Oh, Federated Hermes. Okay, let's take a look at Hermes, the high-end clothing store. It's $40.41 a share. FHI. So in my Excel model, and email me if you want a copy of this Excel file. I give it all for free. I'm not going to charge anything. So I put last year's stock price because I want to show you what your return would be if you bought the stock a year ago. It just gives you some information and helps you understand how dividends work. Because some people, like I've seen people who mention, oh, the stock, I bought the stock 10 years ago at $20. It's still trading for $20. And they're like, I didn't make any money. And I'm like, actually, you doubled your money if you compound the dividends. Like, you got to think of those things. That's part of your equation. What's the market cap? $3 billion. Let's go. Let's look at that free cash flow. Because this is probably the most important thing when you look at a dividend stock, the free cash flow. Can they afford the dividend? Net income. Net income is also important. And this website, Simply Wall Street, it shows you the buyback yield. I think this is something just to keep an eye on because they buy back 7.3%. So imagine if they paid a 3% dividend, they're giving you 10% back. So if the stock went down like 2%, say for instance it went down 2%, most people would think the stock went down 2%, I lost 2% of my money, but you actually gain 8% because of the buyback and dividend. So you got to think in those terms. Look at it. Look at this dividend they paid. They pay really big dividends if they have extra cash flow. $31, $31, $31, $1.31. So I'm calculating 5.5% dividend. So the reason it says 3.5% is because the way they do it is they take the latest dividend, multiply by 4. So if I put 31 4 times, I get 3.1%. Does it match now? Well, 3.4. I don't know why it's off now, but it could be the timing. Like maybe this is the dividend as of like yesterday or something. I don't know, but it's close enough. So if you bought this stock a year ago, like you paid the $32.46, you would have made almost 25% on the stock, and then another 10% on the dividend yield and the buyback. So you actually have a 35% return. If you put $10,000 into the stock, you'd have $13,500 after 1 year. So let's see, can they afford the dividend? Okay. Annual dividend. This is how much it costs this company to pay dividends. So they spent $92 million. If you own this stock, you received a cash dividend, right? And if you sum up all those dividends paid to all the shareholders throughout the entire year, it's $92 million. And can they cover that? Yes, they cover it 3.7 times with their free cash flow, 3.1 times with their net income. So they could actually pay 11% dividend with their free cash flow and not be out of cash. If they paid their entire free cash flow as a dividend, they could raise it to 11%. So it's a strong buy. So this is a tool to get you thinking about things, because once you start inputting this stuff and you start looking at it, things start to make more sense. Make sure you email me if you want a copy. And always, if you have questions, you want to learn about something, just ask me. I'm happy to share. It's all free. I don't charge for anything. So here's my email. So, yeah, make sure you email me if you want a copy of this. And I'll give it free, no problem at all. Good morning, Scott. Danny Fu, good morning. You must be in Australia or something. Thanks to all the analysis that you run, always been helpful for people like me without a finance background. I'm telling you, you're better off without a finance background because you don't learn anything. You have a clean slate. Hong Kong. Okay. That makes sense. What time is it in Hong Kong? 9 a.m. It's 6 p.m. here. But it's Wednesday probably for you, right? Yeah, you're Wednesday. So what stock we were looking at? A Federated Hermes. It looks like so you have to think about like the company, like how is this company gonna do in obviously most companies do well when people have a lot of money. But when people are tightening their belts, when there's a recession or getting close, you want to think about how will this company do? Federated Hermes. They were founded in 1955. The company offers investments spanning equity, closed-end funds. Aetna acquired a majority ownership stake in Federated Investors in 1982. Dow Chemical. Yeah, let's take a look at Dow Chemical. Another good company. And I have this list of the really high dividends. If you can't think of any. Dow Chemical. It's a good 30 spot 65. What was the stock a year ago? $57.27. So it really came down a lot. What's the market cap? 21,665, 12, 12, 12. Let's look at that free cash flow. Free cash flow is operating cash flow minus CapEx. So they have negative free cash flow. So obviously they're going to be. So if a company has negative free cash flow, you could look at prior years. and you could do an average, or you can estimate, based off of prior years, will they be cash flow positive? And you have to kind of make that judgment. And if you make the right judgment, you may get a massive return. But if you're off, okay, let's what's the buyback yield? 0.9%. So not too high. And they consistently pay a dividend. It looks like, is it quarterly? Yeah, no. That is quarterly. And it looks like it's pretty much the same dividend, 70 cents every, let's see, February, November. I mean, I'm putting it in January, February, the first 4 months. Doesn't matter. I just want to sum the 280. So look at that yield, 9%. They buy back 0.9%. But the stock went down 47%. So if you bought the stock a year ago, you're down a lot. But you only lose money if you sell it. So even though you're getting this great dividend, you're actually down 36% from this investment. But imagine buying it now, and if you still get that 9% yield and the stock goes up 50% back to this level, then you're killing it. That's what we want to do, right? Let's just look at a stock chart. I'm curious how this looks. So it hasn't been trading that long. So since 2019, and you can see it was pretty steady. It wasn't really moving around that much. It did fall a lot from COVID, but it came back pretty quickly. And it's always been in this tight range, except the past few months, it's coming down. But what happened when it came down from COVID? It came right back up. Will this be the same situation? Like, it was trading in the high between 35 and 40 for about 2 months, and then it just fell down. Let's see what this is. Dow and X-Energy Reactor Company submit construction permit application to U.S. Nuclear Regulatory Commission for proposed nuclear project. I thought that would be the reason it fell. So they're maintaining their dividend, which is impressive because they could have cut it, because stock did come down quite a bit, but they're maintaining their dividend. Most companies will cut the dividend, so the dividend yield would be like 4%, 5%, but they kept it now, and the yield's 9%. So I think this stock, you'll see a run up because dividends don't stay at 9%. I'll show you what I mean. Like, it's a share is $31, right? And if you own one share, you're receiving. What happened? That was weird. So if you own one share of $31, you're receiving $2.80 of dividends because you get 4 70-cent dividends throughout the year, right? So how can the yield go down to 5%? There's really only two ways, right? Either the stock goes up or they cut their dividend. And we see they're not cutting their dividend. They haven't cut it. They kept it flat since they pretty much IPO'd. It's been 70 cents every single quarter. So that means the stock price has to come up to like 50 to bring it to a normal dividend. I'll be right back. Okay. So the stock has to go back up to 50 to bring that yield down. Because they would have cut the dividend. The reason they didn't, because they know where the stock price belongs. MPLX. So if you're looking for a midstream stock, midstream companies operate between upstream and downstream. They store and transport oil from upstream. Upstream actually pulls the oil from the ground, and downstream sells it to you, the end user. They also refine. They do refining downstream. Let's see. What was 42.37 market cap? 53. $7.35% dividend. $4.9 billion. All right, that we didn't even look at the results of that previous company. I'm jumping around too much. So the net income is really close to net income and the free cash flow. Interesting, right? This is one of my favorite midstream stocks, MPLX. Let's look at the dividend. They pretty much consist. Look at that. They paid a big dividend in November 2021, $1.28. Let's see, 95.957 we'll just we'll look at the forward yield. I think that's makes more sense. 7.3%. I'm 7.4%. It's close enough. So if you bought the stock a year ago, you'd have a 31% return. Your stock went up 23%, but you also received almost 8% in dividends and buybacks. So not too bad for 1 year, right? And they cover their dividend with their free cash flow and their net income. So this is a buy. It's not a strong buy. If they cover if their free cash flow was, say, double this, and they cover it 2.5 times, then it's a strong buy. But this is just a buy because they can only cover it 1.2 times. OHI, is that Omega? Omega Healthcare, 3823. $38.05. No, 30.79. Market cap 11, 2, 1, 2, 3, 4, 5, 6. This keeps crashing on me, Yahoo Finance. So net income is 400 million. What's the buyback yield? Do you guys like the buyback yield? Look at that, they've added almost 11%. So they didn't buy any stock back. They diluted the shareholders 11%. And they're pretty consistent with their dividend payment, 10. 67 cents. So you might be saying, oh, I get a 7% dividend. What a great stock. But you're actually losing 11% on the buyback. I think I'm going to fix this because it's already priced into the stock to buy back. So I'm kind of double counting. That's what I was thinking about when I was talking about this yesterday. I was trying to think about the buyback. Yeah, I'm double counting because it's already priced into the stock. I don't have to do it again. It's just for visual purposes. So it cost this company $785 million to pay dividends to its shareholders. And they could cover their dividends one time, a little less than one time with their free cash flow. So this is a sell because they can't cover their dividend even once because it's slightly below 1. They can cover their net income with their dividend payment. And they have been paying their dividend consistently, so they do get 1 point for that. But it's a sell. Anything with a 0 or 1, it's a sell. So that's why you kind of have to look beneath the hood of the car and understand how it's doing. You can't just kind of look from the outside and not do any kind of additional work. So yeah, that was an interesting one. Why is Omega Healthcare struggling like that? And the stock is up. But it is trading back to its 1998 levels. Yeah, from the past decade, it's been fairly steady, up and down, but in the same ballpark. It did fall a lot during the dot-com crash. It looks like it started falling in 98, 99 and reached its all-time low in 2001. In 2003, it also got low again, but not nearly as low as 2001. So that's interesting. Omega Healthcare. So what about these really big dividends? Especially like when you see a stock like 1.5 billion, a little Icon is a weird company. Carl Icahn. So I would probably avoid that one. But this TORM seems really interesting, right? Because 1.5 billion market cap and a 46%. So let's look at TRMD. Can you filter these for strong dividend payment history? How do you do that? What do you mean by strong dividend payment history? I don't know, like, there's no column for that. TRMD. Yeah, that's what we're doing. That's what we're doing right now. That's what I'm doing in the video. I'm kind of digging into these stocks a little deeper to try to understand them. Because a lot of people just look and say, "Oh my God, a 30% dividend! I'm buying the stock," and then they're down 50% on their investment, and the company cuts their dividend. So it's like it was a waste. But I want to see. Yahoo Finance says it's 15%, but let's put everything into the model, and then we'll decide. 243 million free cash flow. That's pretty good. I mean, it's positive, so it's good. Matt, oh yeah, I appreciate it. Yeah, I'm learning with you, so I'm trying to come up with these different ideas, different ways to look at stocks. So okay. So they're definitely not consistent with their dividend. So if you want a dividend payment, this is probably not the best stocks to look at. They paid 60 cents in March. One 1.5. It's all over the place. 1.8, 1.2, 0.6. Let's just use the 0.6. This is why Yahoo Finance is 15%. They use the forward dividend yield. There, you see that 14.44%? Because they take the current dividend, which is 60 cents. That's the current dividend right here, 6 cents. And they multiply it by 4. So it's a forward. That's why they call it the forward dividend. This website is 30%. They're taking the last 4 dividend payments, the sum of those 4 numbers, and then dividing that by the stock price. I think the forward dividend makes more sense. So let's. Okay, Matt, thanks for checking in. So even if you made 15% on the dividend, you still lost 54% on the stock. That's why when you chase the yield, you get burned. But they could cover their dividend. They cover it 1 time with their free cash flow, 2.5 times with their net income. So this is either way. It's more of a coin flip. I mean, if you're looking for some risk, this would be a stock to buy, but it's probably not a stock I would buy, to tell you the truth. But it's good to look into it on this level to get an idea, because it does look tempting on this. Because it's not that small, 1.5 billion, but let's stay. Let's stay above 1 billion market cap, because when it's below 1 billion, I think the risk is kind of high. That's why I looked at this. I was like, 46% dividend on a $1.5 billion company. Zim, we all know Zim, right? So which one? Is there another one we should take a deeper dive into? So lots of marine shipping stocks, marine, oil and gas. A REIT, asset management. So you got to be careful with some of these stocks, like these asset management stocks. What they do is they dilute shareholders. So if they pay you a 20% dividend, they're diluting shareholders 20%. So you don't get anything actually. TELUS, the big Canadian, the AT&T of Canada. So is TELUS, maybe TELUS. Let's see what they say about this stock. Tell us about the stock. I can't stand Yahoo Finance. It keeps crashing. TELUS. Let's look at the stock that trades on the Canadian Stock Exchange since. So it's $20.99. What was the stock price a year ago? 22. So it's down a little bit. Not pretty big company. 31. Let's look at their free cash flow. Their net income, 20 billion. Are they buying back stock? No. And they're really consistent. They always raise their dividend. Let's see. They paid 40 cents, and they pretty much pay every quarter. So we have a 7.6%. They're 7.7%. We lost 5% on the stock because it went down in a year. It was 22, now it's 21. So we actually made 3% on the stock in the past year. But they cannot cover their dividend with their free cash flow. Only 0.6 times. So that's why it's either way. They could cover their net income, and they consistently pay a dividend. So that's why they get the either way. So it's not a slam dunk. That's the most important thing, the free cash flow. ARE. Oh, Alexandria Real Estate. Okay. Let's see what the stock was a year ago. Well, it's really come down. $13 billion. And what's the free cash flow? $1.5 billion. And the net income, $131 million. Are they buying back stock? 0.7%. Okay. And they're probably pretty consistent. Yep. They're. What's their latest dividend? $1.32. 7.3%. So the stock went down 39%. Alexandria Real Estate. You might want to look at the portfolio. It was 220, and just in 2022 it was 220. So it's really come down a lot. You might want to just get an idea of what kind of property. So it is commercial. So their tenants are Moderna. So it looks like medical companies. That's probably their focus. So they own office buildings and labs, mainly for life sciences and technology companies. So 36% of its revenue is in Boston. The Bay Area is 23%. Yeah, it's tough. Office space is, people are saying that it could crash. That could be the next thing to fall. I think these type of tenants are okay. I think the shopping centers are the ones that I think there's a lot of downside potential, because it's very expensive. Like the rent, if you're in a shopping center, it's really expensive to rent because you're paying a premium because of the foot traffic. But a lot of these tenants are in like office buildings where you don't even know who's in there. So it's much, much cheaper, the rent. But they usually have big spaces, so it costs them. I'm in San Diego and I see a lot of their building spaces. Okay. That's the thing. If you invest in a company and you're familiar with their product, it just makes it more tangible, and it just gives you a little more comfort. Yeah, but why is it down from 220? So it's down like 65%. $220 to 73. It really kind of came down. It's down 67% from the peak. And the peak was pretty recently. I would take a look at revenue. Looks real good. Revenue is growing a lot. But I have a feeling, well, cash flow looks pretty good. It did flatten out the past year, but it still looks pretty solid. Earnings are always going to be a bit bumpy because of it's real estate, so there's lots of write-offs. So you might have some negative years, or you might have very little income because if you took a big impairment on a building, it's really cash flow. I actually I'm a controller at a real estate development company, and we're very it's always the same drill. We have a ton of assets, but we're always struggling. Cash flow is always hard because all our cash is tied up into the real estate. Correction, maybe. Seems like good OOD tenants. Yeah, definitely a big correction. Let's see what Simply Wall Street at 151. Analysts are at 112. It definitely seems undervalued. I don't think, based on their numbers, doesn't look like the stock should have went down nearly 70%. But that's just the market for you, right? Okay. So what are these other ones? It's some really wild dividends. Annaly, I think they do a lot of dilution. So you may get a 14% dividend, but they may dilute you 10%. So it kind of wipes out your. Look at Stellantis. You don't see many auto manufacturers on this list. I like this company. They make a tangible product, a product we all use, cars. Talk about a stock that's getting beat up. STLA. I think they're one of the biggest car manufacturers in the world. Let's look at their free cash flow. They've been getting squeezed pretty hard. They're negative now. I'll just go with 0. Net income is 5.4 billion. Look, their stock's going down so much that they're buying back 12% of their shares. That's how confident they are. April. So their annual dividend. So it looks like they're paying it pretty consistently. But the last dividend, 57 cents. So it's come down a lot because in 2023 it was almost $1.50, then $1.23. Now it's 57 cents. So they're definitely, because they're not making as much money. So obviously they have to cut their dividend. So this is 8%. I don't see how. $0.57. I don't know how they calculate this. How they getting? They're 8%. I'm 6%. and this is 13%. Any good material companies to research? This definitely, you're not getting a, that's the thing. You should probably look at the data. You're not getting a 13% dividend on Stellantis. There's no way you're getting that. I mean, it's just the math. I'm at 6%. I don't know how they're coming up with you know what it is? They may take their dividend and multiply it by 4, thinking it's quarterly. I don't know how they get it. Yeah. Okay. Any good material companies? That's the thing. Yeah, vacancies. Alexandria. You should look at their the presentation slides. I don't know which one is their presentation slides. Yeah, I don't know. Most most REITs put together like a big packet of um yeah, it's a, if anybody knows where you get the PowerPoint presentation for this company, I'm not seeing it on their website. Maybe supplemental. Okay, this looks like it. Let's get there. Come on. Vacancy. I guess they don't want to make it so obvious where you could find all this information. So this gives you an idea of who's renting from them. So 20% are pharmaceuticals, 20% life science product, service, and devices, biotech. Here's a shareholder return since 1997. So a pretty good return, 1,100%. So they're mostly 91% are triple net leases. Triple net means the tenant pays their regular monthly rent plus taxes, insurance, maintenance, an extra fee on top of that. So they're collecting almost 100% of their rents. But we want to see occupancy, right? Like how much of their space is occupied. Maybe I got to search up occupancy. This is it. Occupancy percentages. So they're in the 90% range. Occupancy percentage in North America, 91%. So they're in the low 90s. So it looks like they're pretty occupied. But if someone is occupied, you got to make sure the tenants are paying their full rent, because sometimes the tenant defaults on their rent, so they cut a deal with the tenant and say, okay, you could just pay us half price until business is back to like back to where it was in the past. Are Americans going to shop more in Mexico? Yeah, I think we're looking for a big rally coming up. That's for sure. I agree with you there. So, what are these other really big dividend paying stocks? REITs are good stocks. Nothing wrong with a REIT. Like Starbulk. I guess we can look at Starbulk. That's a pretty popular stock. A lot of people seem to like that. SBLK. So that's 1469. What was the price a year ago? 25. So it's down a lot. $1.7 billion. And the free cash flow is 416 million. Net income is 304 million. Are they buying back stock? 1.5%. And they have been consistent. It's just it's really all over the place, the dividend. $0.09 before that, 60, 70, 75. That's what I 14.6%. That's what I get, 14.6%. But the stock went down 41%. So you're still down on your investment. But they could cover their dividend. Even with a high yield, they can cover it more than one times with their free cash flow and net income. So it is a buy. But these things there's no guarantees there. Look at the dividends all over the place. Real high, down a lot. It's really based on cash flows. How are they doing? How much money they make that quarter. You have Golden Ocean? Is that on this list? Your Golden Ocean, 13%. I think the people who buy Golden Ocean think they're buying Google, and I think half the people that buy Golden Ocean are just making a mistake, and they think they're buying Google, but they buy Golden Ocean. Down a lot. $1.5 billion. Net income. Buyback. They do buy back some stock. Okay. Once again, you're getting a dividends are really all over the place. 15, 30, 30, 30. Well, it's not too bad, actually. So 14% yield, but the stock went down 45%. I guess that's the big risk with this stock, how much it moves. But they could cover their dividend with the free cash flow and their net income. So it is a buy. Not too bad, right? It's getting hot. Okay. So it's fun kind of looking at these dividends, right? Just a different way to look at it. I'll try to come up with other Excel models to look at stocks. So it's more kind of structured. So it's just easy to follow. Maybe I'll come up with like those other channels do. Like if if they buy back stock, it's check mark. If free cash flow is up, it's check mark. And then to see how many check marks a stock gets. Okay. Well, thanks for joining. Yeah. Thanks a lot. Last half. Anytime. Okay. I'll talk to you guys later. Thanks.